right, let's discuss how to invest in the market in 2025. And what I mean by that is with the thought that a lot of people have that stocks may be overextended after doing 2 years in a row at almost 25%. To start, I run a wealth management firm. I spent over a decade on Wall Street, graduate degree in finance, a CFP, and a SEMA designation. So let's start and look at the data. Let's set the stage of where the economy's at. Now, this chart is directly from JP Morgan. And what you're looking at here is their words are economic fundamentals are undeniably strong. The blue is current, the gray is the average since 2000. Real GDP or economic growth higher than average, real disposable income higher than average, unemployment rate lower, nominal wages higher, and CPI in line. If I look at this and say the economy's on solid footing. Next, you think about who's coming into office. Donald Trump. And most people would agree that most of Donald Trump's economic policies are economically stimulative. So, with that in mind, the economy's already on solid footing. We're bringing in a president that is going to stimulate it further. That tells me load the boat with risk, right? Well, let's think about this. Over the past 10 years, the S&P has averaged a 13.5% annualized return, which is about 35% above its long-term average. And then you see this. The next 10 years, the big firms are forecasting an annualized return of 6% from BlackRock, 5% from JP, 4% from Vanguard, and 3% from Goldman Sachs. And all of a sudden you start to think about, okay, the economy's on solid footing. Why are they forecasting a quarter to a half of the long-term results that the S&P 500's paid? When it comes down to this, you have to understand where the starting point is. And to look at this, we're going to look at valuations called price to earnings ratios. Now, nerd terms, price to earnings ratios are stocks expensive or are they cheap? When PEs are high, stocks are expensive, everyone's jubilant. When they're low, it's when only Warren Buffett's buying because there's blood in the streets. And this chart right here shows you each one of these dots is a data point throughout history, and it corresponds with what the price to earnings ratio was at the start of that year. And then on the y-axis, it tells you what the subsequent annual 5-year returns were. Suffice it to say, when stocks are cheap, shut your mouth, load the boat. They're going to rock and roll for the next 5-year period. When stocks are really expensive, that's not quite as good of a prerogative. And you'll see right now we sit in a stance where stocks are more expensive than they've been 96% of the time. So you take that red dot, run the line across, it hits at 3%. History doesn't repeat itself, but it rhymes. And what that tells us is we have to start thinking about more muted returns looking forward in the future. So that's stocks. Now let's talk about bonds, one of the other main asset classes, real quick. Is there value in public bonds? Yes and no. When you think about bonds, what you look at is the treasury curve. Let's take a 10-year treasury, for example, which yields currently around 4.7%. And then if a company is going to issue debt, what they do is they pay a spread on top of that 10-year treasury rate. And that's what we're looking at here. The top line are high yield or junk companies, and the bottom line are investment grade high quality companies. The lower the spread is, the amount they're paying over treasuries to issue debt, the less value there is there. And you'll see going back to 1998, that's the only time that we've seen a lower credit spread than it is right now. So I don't know that there's a ton of value in public bonds either. Okay, how about cash? Well, you'll see right here, federal funds rate. Cash tracks federal funds rate, whether you're talking about CDs, high yield savings accounts, money markets, or treasury bills. As federal funds rate goes up, the yield that you get on those instruments that are cash-like goes up. As yields come down, they recede. And what you'll see right here is the projections moving forward are that the yields on cash are going to come down. And that's showing about 3% a couple of years out from now. Then you associate taxes on top of that. And if you're in a high tax bracket, the yield is sub 2% after tax. All right, Taylor, you hate everything, stocks, bonds, cash? No, we don't hate everything. So what we're going to talk about going forward now are a couple of the areas of the market where we see value as value investors. Every portfolio we build for our clients at LifeGoal is a combination of stocks, bonds, and alternatives. What we're going to do in this conversation is talk about 3 opportunities that we see value in the current market. Let's look first at something that can be bought in public stock land. Dividend growth stocks. Not to be confused with high dividend payers, these are the companies that can consistently grow their dividend on a year-over-year basis. And what you'll see in this chart right here is that going back to 1973, you'll see that dividend growth stocks markedly outperform the S&P 500. And what you're also going to understand is why that takes place. If you think about a company that's able to pay out more every single year than they paid before in the format of dividends, that means they're taking in really significant cash flow to afford them an ability to pay that out. And you think about the last few years of companies have been able to grow their dividend, that takes them through a nasty COVID and a nasty inflationary pressure of 2022. So dividend growers have outperformed. And then the kicker on this is the S&P 500 trades at a price to earnings ratio between 21 and 22 times. The price to earnings ratio right now on dividend oriented stocks, dividend growth stocks, is sub 17% or sub 17 times. So therefore there's value there when looking at it versus the broad market. Next, let's talk about private equity. These are companies that are not publicly traded. When you look at the US market and you look at companies that do over $100 million of annual recurring revenue, you have to realize that only 14% of them are publicly traded. This is getting access to the other 86%. And what you have to understand is there's better value there than there is in public markets. Looking back to 2021, what you'll see here is that private equity is trading at a 12% discount to the valuation it was at back in 2021. So there's value there. And you look at that relative to the S&P 500, the S&P 500 has gone up 25% from its high watermark in 2021. They both work off the same economy. So what that tells me in all likelihood is that one of those markets is overvalued and the other one might be undervalued or a combination thereof, which is why we think there's real value in the private equity space. Last idea we'll talk about today is infrastructure. We're going to talk about it both from the debt and from the equity side, bonds and stocks. So let's start out with bonds. Well, if you think the S&P 500 is going to do 6% a year like BlackRock did, which is on the high end relative to the other firms, right now infrastructure bonds are yielding 11.6%. That's the yield. So if bond prices just go sideways, that's the coupon you're going to clip along the way. And now you may ask, what's the level of risk? Well, when you're buying bonds, the risk is that they default. They can't pay their debt obligation. And you can see right here, over the past 40 years, infrastructure bonds have only defaulted at a 1.2% rate. And the reason there's such nice opportunity right there is because the government is incentivizing more capital to come in the infrastructure space. What is infrastructure? Well, where the need within infrastructure is right now is energy build out. AI is the world's craze right now. AI uses an unfathomable amount of energy, and our infrastructure system just is not in a place where it can produce enough to generate the energy needed to power AI, which is growing magnificently. So that's the need. Now let's think about the equity side when it comes to infrastructure. It's attractive as well. When you're building alternatives into a portfolio to complement stocks and bonds, you want to make darn sure that those alternatives are doing something different, really diversifying the portfolio. So first, let's look at how they diversify against bonds or fixed income. What you're looking at here are the worst quarters over the past 20 years. And you'll see that bonds at their worst sell off 1% in those nasty quarters. But look at the magnificent returns that are produced by infrastructure equity during those periods. They're up 4% in those quarters. So check the box. You're diversified from bonds. Now let's think about stocks. In the worst quarters over the past 20 years, the stock market has averaged down 14.5%. Meaningful downside there. And then you look at what infrastructure does during those time frames. I'm not saying it kills it, but it keeps its head above water. And then what that allows a manager to do is if you have an asset that stays flat, basically, as stocks sell off 15%, then you're able to trim that position and rotate out into stocks where there might be a dislocation and some real significant value in the short term. Lastly, why do you build a portfolio of stocks, bonds, and alternatives? Well, most financial advisors typically have built out portfolios of stocks and bonds. That's what you see in green and blue here. And I don't care if you're an aggressive investor all the way down to a moderate or a conservative investor. This graph shows with the inclusion of the gray, which are alternatives. Every single one of these portfolios sees higher returns with less risk. Please raise your hand if you do not want higher returns with less risk. No hands are up right now. That's just a natural inclination. So, right now, in a market that might be relatively frothy from just an outright public stock market option standpoint, here are the three areas of value that we see. Dividend growth stocks, they're trading at a meaningful discount and have actually outperformed the S&P 500 over time. Private equity has also outperformed the S&P 500 over time and is at significantly lower valuations right now. And then lastly, infrastructure. It's the white hot need as we need more energy build out for AI, and it does a phenomenal job of diversifying from the typical stock market that everyone's invested in. I hope this helps, guys. There's where we see value in 2025. And if you'd like to chat with us at LifeGoal, there's a link below to schedule a call. We'd love to chat with you. Also, hit the subscribe button. I will continue to put out content like this every single week. Thanks so much, guys.